Okay. Secretary of the Society, Mukesh Trivedi, Saroj Manyar, Jagdish Punjabi, Speaker for the day, seniors in the audience, and a warm hi to all my young friends. I see a lot of young faces over here. I guess many of you are students and articles. How many students over here? Wow. And how many of you given exams recently? Wish you all the best, and I'm sure most of you will succeed, not fall in the 3%. I mean, you fall in the 3%. There. Okay. The budget for 2013-14 was the last full budget of the outgoing UPA government before the elections. The targeted fiscal deficit for the year was 4.8%, and I was surprised to read that the actual deficit was 4.5%. So they overachieved, and this comes as a surprise because of the fact that in the last leg of the government, there were the whole government was paralyzed, no policy decisions were being taken, and yet they've curtailed the deficit. So that was a pleasant surprise. But when that budget was announced and provisions were there, a lot of people had said good things about the budget. And I guess because it was the last budget before the elections, a lot of feel-good factors, sound-good factors were factored in. Some of the initiatives that were announced, if I may just summarize, for the agriculture sector, there was the provisions to counter the rising food prices. For the rural sector, education, health, sanitation, employment, rural development. In the areas of infrastructure reforms, measures such as infrastructure debt funds, enabling access to bond markets, increasing corpus of rural infrastructure, development fund, a regulatory body for the road sector. All these sounded like old promises in hindsight now when you hear them. Several industrial corridors, smart industrial cities were announced, road projects were announced, improving rural and urban infrastructure was given a thrust, establishing new ports, harbors, and then there was that first all-women's bank, which I was very excited about. I don't know whether what it meant, all women, for the women, by the women, of the women, but yes, that was the third country in the world to announce such a bank. Frankly, I don't know what's the status of all these ambitious announcements which are there, but surely there are certain things which hurt and hurt us bad in terms of the mobile phone becoming dearer because of the excise duty from 1% to 6%. The real estate sector, saw the prices marginally affected because of the TDS on sale. The commodities market saw the prices because of the CTT increased. The restaurant business, air-conditioned restaurant business, which you all go to, the prices would have gone up because of the increase of service tax over there. All in all, the budget was a populist budget, an ambitious budget with a lot of promises. But for us, what matters is how the amendments have come in, what are the amendments that have come in, what are the things that we need to take care of when we file the returns for our clients. A lot of procedural changes, some forms, some e-filing, a lot of these things. And we have with us Jagdish Punjabi. He's a rank holder, chartered accountant. He's been a professor, he's been a lecturer with 2 colleges. He's been the head of the accounts department of the college. He has delivered a lot of lectures and talks at various forums, including Bombay Chartered Accountants Society. He is a regular contributor to the column Tribunal News in the Bombay Chartered Accountants Journal, BCAJ, and he is a member of a few committees with us. With these words, actually, you know, this hall, I was just informed, is about 536 capacity, and I see at least about 50, 60, 70 people standing. So it's close to about 600 people that we have today. That speaks a lot about his popularity with all of us, as well as the topic which is there. With these words, and what are 600 into 2 hands, so 1200 hand salute. We welcome Jagdish Punjabi. All yours. And you know, the tradition of VC is to give memento before, so we don't take chances.
Good evening, everybody. The President of the Society, Snashad, the Secretary Mukesh, and Saroj, seniors and friends. It's a pleasure speaking before you on the amendments to the Act which are applicable for the assessment year 14-15. What we are today going to cover is the amendments which effect the computation and filing of return of income for assessment year 14-15. Having covered the amendments, we will then proceed to see what are the changes, if any, in the forms, and we have many there. And then we have 2 or 3 recent notifications. Yesterday's development that wealth tax return is also to be filed electronically. In certain cases, we shall make a reference to that notification as well. This, since we have a long way to go, we straight begin with the topic. Since we are dealing with filing of return of income, let's first have a look at who's obliged to file a return of income under law. And we have all firms, including the LLPs, irrespective of their level of income or their having suffered a loss. All companies, irrespective of the level of income or their having suffered a loss. Persons other than company or firm will be required to file return of income only if their total income during the previous year 13-14 exceeds the maximum amount chargeable to tax without considering deductions under 10A, 10B, 10BA and Chapter 6A. Therefore, total income as computed by you plus these deductions under the sections just now referred, if it exceeds the maximum amount not chargeable to tax, then such persons are obliged to file return under section 139(1). Charitable or religious trust, similar to what I just mentioned, if the total income in the previous year exceeds the maximum amount not chargeable to tax without giving effect to section 11 and section 12. Every person to whom notice under section 142(1) or 148 has been issued is obviously obliged to file a return pursuant to that notice. And any resident person other than not ordinary resident, so we are talking of R and OR category, who may not be having income, may not be obliged to file return under the earlier categories which have been mentioned. But if such a person has any asset including financial interest in any entity located outside India or has a signing authority in any account located outside India, will be obliged to file return. You then come to a category of research association, news agencies, associations or institutions referred to in 1023A, 23B. All these institutions and associations are required to file the income, the return of income if the total income exceeds the maximum amount not chargeable without considering the exemptions under section 10. University, college or institution referred to in 35(1)(3) is required to furnish return of income or loss even if otherwise it is not required to furnish a return. Political party, if its income without exemption under 13A exceeds the maximum amount not chargeable to tax. Now then comes the question, yes, I now know that I am obliged to file a return. If I am obliged to file a return, what then is my due date? For now, due date of filing would depend upon three things. A, my legal status. Second, whether I am covered by the provisions of section 44AB of the Act, whether I am required to get my accounts audited under 44AB or not, and lastly, whether I am required to obtain a transfer pricing report under section 92E. Now, every person required to obtain a transfer pricing report is required, the due date of filing return of income is 30th of November. So all persons required to obtain transfer pricing report 30th of November. Every person who is not required to file obtain a transfer pricing report but is required to get the accounts audited either under section 44AB or under any other law, the due date would be 30th of September 2014. Now, working partner of a firm which is liable to tax audit under section 44AB or is otherwise required to get the accounts audited. Now you may say, where is the need of otherwise required to get accounts audited? An LLP may be required to get accounts audited under the LLP Act. Therefore, working partner of such firms, the due date would be 30th of September. Please make a note, if a firm is covered by transfer pricing, the due date to file return of income of the firm would be 30th of November. However, due date for filing return of income of a working partner of such a firm which is required to obtain a transfer pricing report yet continues to be 30th of September. This is an anomaly which one must make a note of. Companies, whether or not required to obtain transfer pricing report, whether or not required to get their accounts audited under 44AB, the due date is 30th of September. Everybody else, the due date is 31st of July. Belated return, if you have missed the deadline, can be filed any time up to 31st of March 2016. Return filed under 139(1) by the due dates mentioned above. Only if you have filed a return by the due dates, you can revise the return anytime up to 31st of March 2016. If you have obtained or approval to an advance pricing agreement, then to give effect to the advance pricing agreement, you are required to file a modified return within 3 months from the end of the month in which the advance pricing agreement was entered into. So now we have gone through who is obliged to file a return, by which date is it to be filed. We now come to what are the tax rates. Tax rates again would depend upon my legal status. For individuals, we have three baskets or three categories. Individual who is resident and is a very senior citizen. That is, he is more than 80 years of age as on 31st of March. Individual who is a resident and is a senior citizen. That is, he is more than 60 years of age. After 80 years, you become a very senior citizen. After 60, you are a senior citizen. And rest will be other individuals. The threshold exemption for very senior citizen is 5 lakhs. For senior citizens is 2.5 lakhs. And for other individuals, HUF, AOP, BOI, the threshold is 2 lakh of rupees. Thereafter, up to 5 lakh of rupees, the slab is 10%. From 5 lakhs to 10 lakhs, the slab is 20%, and thereafter it becomes 30%. The tax rates stated here are to be increased by surcharge and education cess and secondary and higher education cess. The cess is at 3%. Surcharge rates, we'll have a look at it in a next slide. Cooperative society, not much to say. Partnership firms, liable to tax at flat 30%, including the LLPs. Domestic companies, 30%. I'll make a reference to only the more important categories. Foreign companies, in respect of royalty and technical know-how fees, in respect of an agreement which has been entered into on or after 1476, the rate is 25%. For other income, it is 40%. Companies are also required to pay MAT if the tax on the total income is below the limits mentioned, below the amount mentioned in 115 JB. MAT or minimum alternate tax or tax on book profits, as we commonly know it, is at the rate of 18.5%. You have alternate minimum tax. So you had minimum alternate tax, and now you have alternate minimum tax. Alternate minimum tax payable by assessees other than companies, again at the rate of 18.5%. Then you have tax on dividend declared, distributed or paid by a domestic company, if any. Of course not relevant right now. This is as and when you declare, distribute or pay dividend, it is 15%. Tax on buyback of shares and tax payable by securitization trust. Now this is a slide dealing with trusts, so you can have a look at it later, because we have, what we will be doing is some of the slides which are not of wider importance to many of us, we shall skip them. They will always be there for your reference. Now, apart from the rates which we just saw, there are certain sections of the Act which prescribe tax rate for certain kinds of incomes. So in the next 2 or 3 slides, we have summarized the tax rates under various sections of the Act. Under section 111A, short-term capital gain on sale of securities listed on a stock exchange and on which STT is paid is 15%. Tax on long-term capital gains under section 112 is 20%. Please note that under section 115BE, if income referred to in section 68, 69, 69A, B, C and D is included in your total income, such income is effective this year taxable at the rate of 30%. The income of a firm, we already mentioned, is at the rate of 30%. Now we have a look at the surcharge. Up to 1 crore of rupees income, total income or MAT or AMT up to 1 crore of rupees, there is no surcharge payable. However, surcharge is payable if your total income exceeds 1 crore of rupees but is up to 10 crore of rupees. Then in that case, surcharge for individuals, HUS, AOP, BY, firm, etc., other than companies, is at the rate of 10% if the total income exceeds 1 crore. Your cess is, both the cess together is at the rate of 3%. Cess is to be calculated on the amount of tax plus the surcharge. In case of companies, domestic companies, the surcharge is 5% if total income exceeds 1 crore but is up to 10 crore of rupees. If total income exceeds 10 crore of rupees, then the surcharge in case of domestic company is 10%. The corresponding figures for foreign companies are 2% and 5%. Now, when surcharge is levied, it is quite possible your surcharge is 10% of the total tax. So when your income exceeds marginally by the threshold of 1 crore for levy of surcharge, possible that the tax increase is greater than the income increase. So in such cases, you get a marginal relief. You cannot be asked to shell out more than what you have earned incremental. That is what we call it as a marginal relief. Now, having seen the tax rates as well, we now come to which form am I required to file my return in. Which are the forms available? We have ITR 1, which is applicable to individual having income only from salary, pension, house property, other sources. Which means if I have business income, if I have income from capital gains, I am not eligible to file my return of income in ITR 1. Apart from this, there are other cases where I cannot file return in ITR 1. Those cases are mentioned in the form itself. What are those? The cases are if I have more than one house property. So if I have one house property, that's fine. But if I have more than one house property, then I cannot file my return in ITR 1. Similarly, if I have brought forward losses from earlier year, either under the head house property or other sources, because if I have business income, anyway I am not liable to file return in this form. If I have income which is winning from lottery or income from resources, or if I am an OR having foreign assets or signing authority in a foreign bank account, or if I am claiming a foreign tax credit or a relief under section 90, 90A or 91 as the case may be, or if my exempt income is more than 5,000. So if I satisfy any of the conditions on the mentioned in the column on the right hand side, I am not eligible to file my return in ITR 1. If I am not eligible to file return in ITR 1, then I come to ITR 2. Who can file return in ITR 2? It's only the individual or an HUF. But if the individual or HUF has business income, then again ITR 2 is not applicable. Therefore, the difference between ITR 1 and ITR 2 is that if my income exceeds 5 lakh of rupees also, I can file ITR 2. If I have got capital gains, I can file ITR 2. If I have got more than one house property, I can file ITR 2. The only disqualification is that if I have business income, I cannot file ITR 2. ITR 3 is to be filed by an individual or HUF who is a partner in a firm and who does not carry on any proprietary business. So I should be a partner in a firm, I should be individual or an HUF, and I should not be carrying on my proprietary business. Therefore, there should not be income under the head income from business other than remuneration from a partnership firm or maybe interest on capital. ITR 4 is for individuals or HUFs having business or professional income. Then you have ITR 4S, which is to be filed by individual or HUF having presumptive business income computed under 44 AD or under 44 AE. So if I have business income which is computed under the presumptive sections, then I can file Form 4S. However, if I am RNOR and have a foreign asset or a signing authority in a foreign bank account, then I cannot file 4S. If I have a claim to make for foreign tax credit or a relief under 90 or 90A or 91, or I have income which is exempt exceeding 5,000 rupees, then again 4S is not applicable. Sorry. ITR 5 is to be filed by persons other than individual, HUF and company. So which means it will be AOP, BOI, etc. Who cannot file ITR 5? Persons who are required to file returns under 139 4A, 4B, 4C and 4D. They are the people who are required to file return in ITR 7. Companies are required to file return in ITR 6. However, certain companies can file return in ITR 7. So in case of companies, you have to check first whether you are required to file ITR 7. If the answer is no, you come to ITR 6. But ITR 7 is by companies which carry on charitable or the religious activities. Now, having seen which form do I use, the next question comes, do I file my return physically or do I need to file my return electronically? Do I need to sign my return as I traditionally do, or do I need to affix a digital signature to my return of income? So here is a chart where we have tabulated the manner in which the return of income is to be filed. Now, all persons whose total income is up to 5 lakh of rupees, so total income up to 5 lakh, you have an option to file the return of income physically. However, ensure that in spite of your income being up to 5 lakh of rupees, you are not required to furnish a report of audit under either 10A, 10AA, 44AB, 44DA, 50B or 92E. Therefore, though your income may be less than 5 lakhs, but if you are required to furnish report under any of these sections, then you have to compulsorily file your return electronically. The option of physically filing your return is no longer available in that case. If your income is, if the total income is in excess of 5 lakh of rupees, then it's compulsory to file a return electronically. Such return may or may not be digitally signed except for companies where digital signature is a must. If you are a firm or an individual or HUF which is required to furnish a report in the sections we just saw, then electronic filing is compulsory. Digital signature is also compulsory. Companies are required to file the return electronically and have it digitally signed. persons claiming benefit of DTAA under Section 90 or 90A or claiming a unilateral relief under Section 91 are required to file the return electronically. Persons required to furnish return in ITR 7, we have two categories. Those required to furnish report in one of the sections mentioned, they are required to file the return electronically as well as digitally sign it, whereas others need to file it electronically but they need not digitally sign the return. Individual or HUF not having any income or maybe having any income but having foreign assets outside India or a signing authority in a bank account outside India are required to compulsorily file the return electronically. With this, we now move over to the second part, that is the amendments in the law which are effective from assessment year 14-15. These amendments take effect for the first time in this assessment year. Here we have classified the amendments. These are not necessarily all the amendments, but these are what we believe are significant amendments which will affect computation of income in a vast majority of cases. Now the first amendment is to Section 2(1)(a) and 2(14). Now by these sections define the terms agricultural income and capital asset. These definitions have been amended. Prior to amendment, the position was that the land situated in an area notified by the government was regarded as a non-agricultural land. So if land was situated outside the local limits and it was in an area which was notified by the central government, then such land was regarded as non-agricultural land. Income from such land was not agricultural income. The government could notify land which was situated within a distance of 8 kilometers from the local limits of a municipality. How could the government notify it? By notifying it, it had to consider the extent of scope for urbanization of the area and other relevant considerations. Now, post-amendment, the system of notifying has been taken away and a land shall be non-agricultural land considering the population of the local authority or the cantonment board. Now, if the population is more than 10,000 but up to 1 lakh, then land situated within 2 kilometers. The land situated within 2 kilometers from the local limits of the municipality or cantonment board will be non-agricultural land. If the population is more than 1 lakh but is up to 10 lakh, then the land situated within 6 kilometers from the local limits of the local authority or cantonment board will be non-agricultural, and if the population is more than 10 lakh, then the land situated within 8 kilometers from the local limits of the local authority or cantonment board will be non-agricultural land. Now for this purpose, how do I ascertain population? Which date do I take? They say ascertain population by the census whose figures have been published before the first day of the previous year. Therefore, we are dealing with assessment year 14-15. The previous year is 13-14. So we have to look at that census whose figures have been published before 1st April 2013. The figures of census of 2011 were published before 1/4/13. So you have to go by the figures. Then I made a reference to 2 kilometers, 6 kilometers and 8 kilometers. The question arises, how do I measure this distance? Do I go by the road distance or do I go as the bird flies? That is aerially. The law now provides that the distance has to be measured aerially. You are not required to go by the road distance, but you have to measure the distance aerially. Now, the next amendment is in section 10, subsection 10D. Now, under section 10, subsection 10D, any sum received under a life insurance policy, including the sum allocated by way of bonus on such policy, is exempt from tax. However, the section provides for certain policies in which case the amounts received are not exempt. Therefore, the amounts are taxable. The exemption is denied under this section. Now, one such policy is an insurance policy issued on or after 1/4/2012 if in respect of such a policy, premium payable for any of the years during the term of the policy exceeds 10% of the actual capital sum assured. So conditions were that A, you have taken a policy on or after 1/4/2012, premium payable in any of the years exceeds 10% of the capital sum assured under that policy. Then amounts received under such policy were not exempt under 10(10)(d). Now a proviso has been added to provide that with effect on 1/4/2014, that in case a policy is issued on or after 1/4/13, in case policy is issued on or after 1/4/13, and it is for insurance on the life of a person who is a person with disability or a person with severe disability referred to in ATU, or is a person suffering from disease or ailment which is specified in the rules made under 80DBB, then instead of 10%, 15% is to be substituted. So if you fall into the second category, so you have some relaxation from 10% to 15%, considering the fact that the persons insured, as mentioned here, fall into a special category. The term actual capital sum assured has also been defined. Now when we paid premium, I am taking ATC also together, similar provision was there, that if at all the premium payable under the policy was more than 10%, then the excess over 10% was not to be allowed as a deduction under ATC. Now identical amendment has been made in ATC as well. So now if it, instead of 10%, if it is policy on the insurance of persons to which the special category we have referred to, then the 10% limit stands increased to 15% even under ATC. Now 1034A gives exemption on buyback of shares by a domestic company if the shares are not listed on a recognized stock exchange. When a domestic company buys back the shares, a tax has been levied on the domestic company under 115QA. Now since tax will be paid by the domestic company under 115QA, 1034A has been introduced to grant exemption to the shareholder who is receiving such amount on buyback from the company. Securitization trust is now required to pay tax under 115EA. Now since securitization trust pays tax, the investor who receives money from the securitization trust, the income received by such an investor is exempt under 1035A. We now come to a substantive amendment in 32AC. This section is an incentive provision for investment in new plant and machinery. The amount of deduction under this section is 15% of actual cost of new assets acquired and installed after 31/3/13 but before 1/4/2015. Therefore, in the financial year 13-14 and 14-15, I must, whatever are the new assets acquired, 15% of the cost of such assets will be allowed to me as a deduction under section 32AC if conditions are satisfied. What are the conditions? We'll have a look at them. Who is eligible to get a deduction? It's only the companies. Residential status not relevant, domestic, foreign, listed, not relevant. As long as you are a company, you are entitled to deduction under this section. What are the conditions required to be satisfied? The company is engaged in business of manufacture or production of any article or thing. So the first condition is that the company should be engaged in the business of manufacture or production of any article or thing, not necessary that it should be present in one schedule or should be absent from the another schedule. It could be any article or thing. You should be into the business of manufacturing or producing an article or a thing. The company acquires and installs. It is cumulative conditions, acquires and installs new asset after 31/3/13 but before 1/4/15. The term new asset is defined. The actual cost of such new assets exceeds 100 crore rupees. Deduction is 15% of the actual cost, as we saw at the outset, acquired and installed in the financial year 13-14 if the actual cost exceeds 100 crores. So in AY 14-15, you will get a deduction only if the cost of new assets acquired and installed exceeds 100 crore of rupees. Then what will I get in a subsequent year? In assessment year 15-16, it will be 15% of the cost of new assets acquired in financial year 14-15 plus 15-16 minus the amount already allowed as deduction in AY 14-15. Please note, in AY 14-15, you will get a deduction only if the cost of new assets acquired and installed exceeds 100 crores. If it does not exceed 100 crore, you will not get any deduction in AY 14-15, but in the subsequent year, this cost you can accumulate and you will get it as a deduction in AY 15-16. Now, new asset is defined to mean any new plant or machinery other than ship or aircraft. So, new asset has to be plant or machinery. It cannot be furniture, it cannot be buildings. It cannot be ship or an aircraft, and also it cannot mean any of the following items. Which are the five? There are 5 items. Any plant or machinery which before its installation was used either within or outside India by any other person. Obviously, we have continuously been referring it to as a new asset. So it is not new qua the SSC, it should be a totally new asset not used by anyone else earlier prior to your acquisition. Any new plant or machinery installed in any office premises or any residential accommodation, including accommodation in the nature of guest house. So if you have acquired and installed plant and machinery, but it is installed either in office premises or in a residential accommodation, such plant and machinery will not qualify to be called as a new asset. Any office appliances including computers or computer software, vehicles, plant or machinery, the whole cost of which, actual cost of which is allowed as a deduction in computing income chargeable under the head business or profession. We already dealt with the next bullet, which is acquired, which is I will get deduction in AY 14-15 only if the cost of new assets acquired and installed exceeds 100 crores. Otherwise, in AY 14-15, I will not be entitled to claim deduction under this section. Now, the claim under this section is in addition to depreciation allowable under section 32. The deduction which I get under this section does not go to reduce the WDV of the block. I mean, my depreciation will also be on the actual cost, so this 15% is extra incentive, so to say. Well, the deduction goes to reduce my income under the head business. It does not go to reduce the book profits because this is an incentive provision under the Act and not. So there will be no entry as such for this figure in my books of account, therefore my book profit will not get reduced. So I will be ending up with a lower total income under the provisions of the Act, but under 115 JV I will not be entitled to this benefit. Now I will get a deduction under this section irrespective of whether the result of the computation is a positive figure or a negative figure. If it is a negative figure, because of this deduction, the loss will further go up. Such loss will be carried forward as a business loss and not as unabsorbed depreciation. So the carry forward rules of business loss will apply. Now the question is that the section uses the word acquire. It does not use the word owns. Therefore, can I say that when I take an asset on lease, I have still acquired the asset, though I may not be owner of the asset? Well, one may feel that yes, because legislature has used the word purchased, legislature has used the word owned in the section dealing with depreciation. For claiming depreciation condition is you should be owner of the asset. Here he is not saying that you should be owner of the asset. All that he is saying is that you should acquire and you should install. If you have acquired but not installed, you will not get a deduction. So the question will be, when have I acquired and when have I installed, because both must be within that period, and that period is after 31/3/2013 and before 1/4/2015. If I have given an advance prior to financial year 13-14, can I say that I have acquired it? I would believe the answer is no, that's only an advance. The acquisition will be when I become the owner of the asset, when I receive delivery of the asset. By and large, I could say that I have acquired the asset. However, one may have to be careful on the terms of purchase. One may have to see whether on 31/3/13, though if the ownership had passed on to you, but it was with the supplier of the machinery itself, you will, one could possibly take a view that going by the principles laid down in Sale of Goods Act, you have already acquired it in financial year 12-13, and therefore you may not be eligible to claim a deduction here. One may have to be careful. Now, whatever new asset you have acquired, you are required to hold it on for 5 years. If before a period of 5 years from the date of installation, because here we are dealing with two things, acquisition and installation, and there could always be a time gap between acquisition and installation. So they say that you need to hold the asset for a period of 5 years from the date of its installation. Now what happens if I do not hold it? If I have sold it or otherwise transferred it, then they say if you have sold it or transferred it within a period of 5 years from the date of installation, and such sale or transfer is otherwise than in an amalgamation or demerger, then the deduction allowed with reference to the asset transferred shall be deemed to be your business income. Fair enough. What happens if I transfer it in a scheme of amalgamation or demerger? Then they are saying that the deduction allowed to the amalgamating company or to the demerged company will become deemed income in the hands of the amalgamated company or the new company or the demerged company as such. Now, I'm required to install the asset, fine. Am I required to use the asset? Am I required to use the asset for 180 days? The answer appears to be no. The section only says that you must acquire it and install it. Installation would mean keeping the asset ready for use. There is a small amendment. An explanation has been added to section 36(1)(7), which only is applicable only for banks, etc., which says that for the purposes of computing the amount of provision for bad debts, the rural advances as well as the other advances need to be taken together as one block where different percentages are to be applied. So they say both are to be aggregated together, both are to be regarded as one. Then you have an amendment to section 40, clause A, subclause 2B has been inserted. It's not an amendment to, it's an amendment to section 40 by insertion of a subclause in that sense. Now this applies only to a state government undertaking making certain payments to a state government. So A, the SSC should be a state government undertaking. What is state government undertaking is specified, is defined in the section or in the subclause, and such undertaking, which is a state government undertaking, must make a payment to a state government. What should be the nature of payment? The nature of payment should be royalty, license fee, service fee, privilege fee, service charge, or any other fee or charge by whatever name called, which is levied exclusively on the state government undertaking by the state government. Or it could be any amount which is appropriated directly or indirectly from a state government undertaking by a state government. Assuming yes, I am a state government undertaking, I have made one of the payments to which we have made a reference to a state government. What is the consequence? The consequence is that such payment shall not be allowed as a deduction, because 40A, as we know, deals with amounts not allowable, right? So that's the consequence. The state government undertaking is defined. We can have a look at it later. We now come to the next amendment dealing in section 43, dealing with speculative transaction. Now, transaction in commodity derivatives earlier was a speculative transaction. Now they say that if there is an eligible transaction in commodity derivative on a recognized association, then such a transaction shall not be regarded as a speculative transaction. Therefore, income from such transaction will no more be speculative income. It's going to be non-speculative income available for set off against my other normal business losses. As you know, there is different rule for allowability of carry forward and set off of losses which are speculative in nature and losses which are from a non-speculative business. So what is now being done is that income from eligible transaction is identical to your transaction of in derivatives in shares, which means it should be with a transaction entered into by a broker or an intermediary who is a recognized or a registered broker or an intermediary. Transaction should happen on a screen electronically. The contract note should have the unique identity number, it should have your PAN number, it should have a time and the date of the contract, etc. Assuming all the conditions are satisfied, income now will not be regarded as speculative income. Earlier it was speculative income. Now this takes me to a question that I am into this business. Yes, I enter into commodity derivatives regularly. In the past I have suffered losses. At that point in time you classified those losses as speculative losses. In this year I have gain. Which gain you are now saying is non-speculative. Therefore, am I or am I not entitled to set off such speculative losses, though you classified them as speculative losses, against this income, because now it has become non-speculative only by virtue of an amendment in the law. So that takes me to a question whether I can set off a loss which has been brought forward as speculative loss against an income which is non-speculative income. Now, if there is a non-speculative loss, a business loss brought forward, that undoubtedly I can set it off. But the question is that loss which was brought forward as a speculative loss from earlier year, and in this year I have income from commodity derivatives, can I set off the loss, or will the AO or an authority say that no, look here, what you are doing is you are setting off a speculative loss against a non-speculative income which is not permissible in law. Now, similar situation arose in assessment year 67, where the transaction of derivatives in shares was classified as non-speculative. Prior to AY 67, transaction on derivatives in shares was also classified as speculative. The matter came before the Bombay bench of the tribunal in Gajendra Kumar Agarwal versus ITO 142 TTJ 612, where the tribunal said that the nature of the loss has to be seen in the year of set-off. They said it's the same business which the assessee is carrying on. He carried on business in stock derivatives in that case prior to AY 67, and in AY 67 also he continues to carry on the same business. It was the definition in 43.5 which underwent a change identical to the change which we are now having for commodity derivatives. The tribunal said, considering the various decisions of Supreme Court, Calcutta High Court, etc., they came to the conclusion that what has to be seen is the nature of the loss in the year in which it is being set off. They said, considering all the ratios, etc., they allowed the assessee to set off. I believe the ratio of this decision will apply with equal force to commodity derivatives as well. We now come to two sections which will take, to which we have to devote some considerable time. Amendment in 43CA and next is 56 to 7B. Now 43CA is the section under the head income from business. It's not a section under the head income from other sources or capital gains. Why am I making a special mention of this? Because under the head business, I need to compute income according to method of accounting regularly followed by me. I may follow percentage completion method, I may be following project completion method. There is no such thing that I compute income from transfer of an asset. I compute profit of my business. I don't compute income from transfer of an asset. Income from transfer of an asset is computed under the head income from capital gains, not under the head income from business. I am calling it as income from business. It's profits and gains of business or profession. Now what are this section applies to all assessees. It is applicable from AY 14-15. What are the conditions to be fulfilled? The conditions are that the assessee transfers an asset other than a capital asset. Because obviously if you transfer a capital asset, it goes under the head capital gains. The asset transferred is land or building or both. Transfer is for a consideration, and consideration received or accruing as a result of such transfer is less than the value adopted or assessed or assessable for the purpose of payment of stamp duty by any authority or state government in respect of such transfer. What are the consequences? The consequences are that if the four conditions to which we just made a reference are satisfied, the consequences are that for the purpose of computing profits and gains from transfer of such asset, the value adopted or assessed or assessable by the authority or state government shall be deemed to be the full value of consideration received or accruing as a result of such transfer. In simple words, what the section is saying is that if you are an assessee who is transferring land or building or both, and such land or building or both is not a capital asset, and the consideration which is due to you as a result of the transfer or is received by you as a result of transfer is less than the value which has been adopted or assessed or assessable by any authority of the state government for the purpose of stamp duty, then such value which has been adopted or assessed or assessable shall be deemed to be full value of consideration. Now the terms transfer, full value of consideration accruing, etc. are terms which are known to us, the meaning whereof we understand, but we know them in the context of computation of income under the head capital gains. Such words are germane to us when we come to the head business income. The first question, there are a host of issues which could arise over here. Before we get into the issues which would arise or what is a possible legal view which can be taken, let us have a look at it at the exceptions. There is an exception. The exception says that if there is an agreement fixing the value of consideration for transfer of asset, if there is an agreement fixing the value of consideration for transfer of the asset, an asset I mean land or building or both, which is not a capital asset, the date of the agreement and date of registration are not the same, and on or before the date of the agreement, the consideration or part thereof has been received by a mode other than cash. So if I satisfy three conditions, I have an agreement, the agreement is for transfer of the asset, the agreement fixes the value of the consideration, and the date of the agreement and the date of registration are different. Then they say, and of course if you have paid consideration or part thereof, that means I as an assessee have received it on or before the date of the agreement, then the consequence is that the value on the date of the agreement shall be taken instead of the value to which we earlier made a reference. Now this they are saying is a benefit. Fine. Then I as an assessee have an authority or a right to ask the ITO to make a claim to the DBO, and all the provisions of 50C2 and 50C3 shall apply. Now at the outset, compare the language of this section with section 5627B. There it is stamp duty value fixed by authority of either the state government or central government. Here it is only authority of the state government. Therefore, in areas where central government fixes the stamp duty value, provisions of 43CA shall not apply. B. Provisions of 43CA shall not apply to property situated outside India. Why? Because outside India it is not the authority of the state government which fixes the stamp duty value or which adopts. Next question arises that is a building, is a flat under construction covered by this section? When I sell flat under construction, am I covered by this section? you have a host of decisions under Wealth Tax Act to tell you that a flat is different from booking a flat under construction. You have Bombay High Court in Tata Services telling you that a right to obtain conveyance is a right which is a separate right from a flat. In the context of capital gains, we are aware of the controversy that the holding period will commence. There are decisions to say holding period will commence only from the date when the flat comes into existence. Of course, we have decisions to the contrary as well, and one can distinguish those decisions. In the context of wealth tax, always the position was that flat under construction is not bidding. Therefore, legally, one may try to argue that the flat under construction is not covered, but it's very difficult to accept that proposition it's quite doubtful whether the courts will accept that proposition in today's day and age. So one will have to reconcile to the fact that a flat under construction also would get covered by the provisions of this section. Then the next question comes, when do I pay tax on this difference? Because we are talking of taxing the difference between the stamp duty value and the agreement value. In which year do I capture this difference under the head business? At the outset we made a reference that income under the head business is to be computed according to my method of accounting regularly employed. Now if I go by the guidance note of the institute, I as a bidder am supposed to follow percentage completion method. Now under percentage completion method, in which year do I pay tax on this? The answer will be that pay tax proportionately. Under percentage completion method, you record revenue as certain percentage of the agreement. So you will have to either adopt that percentage and apply to the difference. The other view could be that no, please have a look. The section is saying the consideration accruing as a result of transfer of such asset. So there has to be an asset, there has to be a transfer. And as a result of this transfer, there must be consideration accruing. So now, therefore, do I go to the year of transfer? If yes, what is the year of transfer? In Bombay, we enter into an agreement which is registered on day 1 when I book the flat. Is that the day of transfer? According to me, if one has a look at section 5 of the Transfer of Property Act, one would come to a conclusion that for a transfer to take place, the property has to be in existence. Therefore, the transfer would happen on the date when the property comes into existence. And to this effect, you will have decisions of Supreme Court as well. Now, one will have to adopt one of the two positions and take a call. The second position not likely to be accepted by the department, though it could be said to be an arguable position. The next question, one question which we cover is letter of allotment an agreement? Can I say that when I signed a letter of allotment, that was an agreement? So look at the stamp duty value on the date of letter of allotment. In my opinion, the answer would be yes. Letter of allotment is also an agreement if it is signed by both the parties. It should be dated, it should be qua a specific property, it should fix the consideration, and it should also lay down the manner and the dates on which the consideration is due. If all these conditions are satisfied, undoubtedly it would be that letter of allotment is also an agreement. It's very difficult to answer a question whether this question is laying a charge or is only a rule of evidence or is a computation mechanism. This, we can go on and on the issues. I think this would suffice for the purposes of filing the return of income. The rest of the issues can be taken up at the assessment stage. We now come to the amendment to 56. One more point there. Is the section prospective, retrospective or retroactive? I would believe certainly it is not retrospective. Retroactive, yes. If there has been some sale in the past whose profits are now being accounted, the answer would be would the section apply? The answer would be yes, the section would apply. So in that sense, one can come to a conclusion that the section is retroactive. Now what would happen where a part of the profits have already been offered? I am on percentage completion method. Do I offer profits even in respect of that part or that much difference? Supposing I have already offered 50%. Then is it that the 50% of the difference escapes taxation? I would believe yes, because if you are taking a view that the section is prospective, it applies to all profits which I am computing now onwards. 50% of the profits are already charged to tax. They were in the period when 43CA was not in place, and therefore that possibly a view could be taken that they escape taxation. Now we come to 5627B. This applies only to an individual or HUF. So if you are not an individual or HUF, this does not apply to you. This applies when immovable property is received and the property is received as a capital asset. So if you are a trader, if you are buying properties, if you are receiving properties as stock in trade, this section will not apply. Now, here the provision is the same as in 43CA, but this applies to the recipient of the property. 43CA applies to the seller of the property. This says that if there is a difference between what you have paid for and the stamp duty value of the property, then the difference will get captured as income from other sources if the difference exceeds 50,000. There was no threshold in 43CA, but here you have a threshold of 50,000. In which year should I pay tax? This section is clearer that you pay tax in the year of receiving the property, in the year in which the property is received. This section also has two provisos, or rather this clause has two provisos. The provisos provide that if you have entered into an agreement earlier and the date of the agreement and the date of registration are different, and the agreement fixes the value, part or whole of the consideration has been paid on or before the date of the agreement, then the stamp duty value on the date of the agreement shall be taken instead of stamp duty value on the date of registration. Therefore, the section is giving me indications more than once that the year of charge is the year of registration. Now, we just saw while on 43CA that when I book a flat under construction, there is no flat in existence. Therefore, it is not a building. Therefore, what I have received is not a bidding, but what I have received is a right to receive bidding under an agreement. That right to receive a bidding will get converted into a bidding the day the bidding comes into existence. Therefore, in my personal opinion, the view could be taken that the charge under this section will get attracted only when the bidding comes into existence and not till that time as the bidding is being constructed. The next issue would be, as I mentioned, this also does not apply to properties situated outside India. Is this retroactive? Is this section also retroactive? Is it prospective or is it retrospective? Certainly not retrospective. Prospective, yes. Retroactive, possibly. Why possibly? I say possibly because this section was introduced earlier with effect from 1st October 2009. By the Finance Bill 2010, the legislature deleted this provision with retrospective effect from 1/10/2009. The section had become effective, but by Finance Act of 2010, it was deleted with retrospective effect. And what was the reason given to delete the provision? They said there is a time gap between the date of booking the property and the date of its actual receipt. And this time gap is giving rise to a taxable difference. And we don't want to tax the timing difference. Therefore what? Therefore we are deleting this. Now the same thing has been reintroduced today with provisos. Provisos only take care that if you have signed an agreement earlier, we will look at the stamp duty value on the date of the agreement. Here possibly I would say that I can argue before the court that look here you have a case where legislature told me that I don't want to tax this difference. So I went ahead and entered into a transaction. I entered into a transaction only when I read the explanatory memorandum by the finance minister in the Finance Act of 2010 telling me that we don't propose to tax such difference. Therefore, I would believe that one can possibly take a position that this section is not retroactive, though if one reads the section directly, one would come to a conclusion that the section is retroactive. Okay, so that's all on 5627B. Here again we can, letter of allotment is an agreement, we could go on and on these. 80C we've already dealt with. 80CCG is a section dealing with deduction for investment in Rajiv Gandhi equity scheme of 2013. The deduction was only in respect of equity shares, investment in equity shares, listed equity shares. Investment in listed units of equity oriented mutual fund did not qualify. Now by the amendment, two things have been done. A, investment in listed units of equity oriented mutual funds qualify, and earlier deduction was only for one assessment year. Now they say the deduction will be for 3 assessment years. Earlier deduction was not available to people whose income was in excess of 12 lakhs. Now it has been made to 10 lakhs. Question could arise whether for the investment made in financial year relevant to AY 13-14, I claim the deduction. Now for that the same investment, I can claim deduction once again in the second year. Because now your subsection 2 says deduction will be available for a period of 3 years. When I made the investment, the section said deduction is available only for 1 year. The section does not prohibit such a deduction. It does not say that for investments made on or after this date only subsection 2 will apply. Therefore, I would believe that even for such investments a view could be taken that the deduction is available. 80D, a small change. 5,000 rupees is allowed as a deduction for preventive health checkup. The condition was that it should not be paid by, it should be paid by a mode other than cash. Now payment by cash is also allowed. Second small amendment, only central government health scheme was covered. Now they say payment even to schemes notified by the central government will be covered, and you have till date only one scheme notified, which is contributory health scheme of Department of Space. 80EE, what you get here, probably in my opinion you can get it under 24 as well, so I don't see any reason of this, but anyway the section says that it's available to an individual. It's a deduction of 1 lakh of rupees spread over only this year. If there is a spillover, then you can possibly claim the thing next year. If your claim in this year is less than 1 lakh, then you can go and claim it, the balance in AY 15-16, but not more than 1 lakh. What is the deduction for? Deduction is for a loan taken by the individual assessee from a financial institution for acquiring a residential house. So individual should take a loan from a financial institution defined, for acquiring a house. And the loan should be sanctioned between 2013-14. The amount of loan should not exceed 25 lakh. Please note the value of the property, it's not the consideration. It's the value of the property should not exceed 40 lakh of rupees. What the deduction is interest on the loan or 1 lakh as I mentioned. Deduction is available only for 1 year. If you claim a deduction here, then you cannot claim a same amount as a deduction under any other provision of the Act. 80G, a small change, National Children's Fund donation now qualifies for 100%. Earlier it used to qualify for 50% under 80G. GGB and GGC amounts given in cash to an electoral trust will not qualify for deduction. 80IA, the sunset clause. Sunset date was 31/3/2013 for units engaged in generation of power or transmission, distribution, etc. Now the date is 31/3/14. Now JJAA, this deduction was there. It was available to a company whose GTI includes profits derived from an industrial undertaking engaged in manufacture or production. So I should be a company having an undertaking engaged in manufacture or production of an article or thing. Now it is available to a company whose GTI includes profits derived from manufacture of goods in a factory. The only change is that from an industrial undertaking engaged in manufacture or production, now I should be a manufacturer of goods in a factory. The term factory is being defined. There is 30% of the additional wages earlier could mean wages of workmen employed by the assessee, not necessarily by the undertaking. Whereas now they are saying that we give you 30% with reference to additional wages paid to workmen employed in the factory. 87 capital A deals with rebate to an resident individual whose total income does not exceed 5 lakh of rupees, the rebate is 100% or 2,000. Right, buyback of shares we've dealt with, securitization trust we did make a mention. Buyback of shares, the domestic company pays tax on the amount of consideration which is paid to the shareholders for buyback minus the amount which it received. The charge is on the domestic company, the charge is on the shares bought back which are not listed shares. The tax rate is 20% of the distributed income. Of course, surcharge and cess would apply. Right? Securitization trust, not of much importance. Transactions with C+ being a non-cooperative jurisdiction, you have to mention them. Consequences of 94A would follow. You have to, the party in C+ will be regarded as your associated enterprise. Transfer pricing provisions would apply and other consequences mentioned would follow. Now we come to the last part, the amendments in the forms. Now there are certain common changes. First we deal with common changes applicable in the forms by and large. Now obviously suitable changes have been made to incorporate claims for deduction in 80EE and 87A. There is no specific column for claim for deduction under 32AC. So that will have to go as other deductions under the head income from business. If I am filing a modified return, there is a provision to check mark or tick that the return is a modified return or a return is in response to a notice rectifying a defect. Now if the return is in response to a notice mentioned in 139(9), defective return notice 142, 148, etc., the date of notice or the date of advance pricing agreement is to be mentioned in the return of income. Please make a note of this. So you need a copy of the notice when you are filing your return. Mention is to be made if you have entered into a transaction with a person in a notified jurisdiction which is with a person in Cyprus, if at all. 32AC we made. Now if you are carrying on a proprietary concern, your proprietary trade name needs to be stated. Buyback, suitable changes have been made. Now pay attention to this change. Now there is a time lag between the time a deductor deducts TDS and I claim credit thereof. To take an illustration, under section 194I, tax is required to be deducted at the time of payment or credit, whichever is earlier. So if I am receiving 3 years rent in advance, the licensee will deduct tax for 3 years today itself while paying me the rent. Now the tax deducted is for a period of 3 years. I will file my return of income and return the income over a period of 3 years, 1/3 each year. Therefore, I am entitled to credit of TDS 1/3 in each year. So licensor has deducted tax. Licensee has deducted tax in year 1, but the credit will be available partly in year 1, year 2 and year 3. The tax is what we say as TDS claim has been carried forward. So if in AY 14-15 you have TDS claim which is brought forward from earlier years. Earlier there was no provision in the form asking you to give details of TDS claim which have been brought forward from earlier years. Now for each certificate number, you have to identify the certificate number from which you are claiming the credit, the financial year in which it was deducted and the amount which you have brought forward from the earlier years. Now this data in certain cases could be, compiling this data could be time consuming, therefore one will have to be on your toes and start compiling, because this may require you to go back 1 or 2 years depending on how back it was. Difficulty would arise in cases of rent, in cases of people engaged in works contract where income is offered over a period of time. Now everywhere in earlier forms name and address were separate columns. Now they have clubbed name and address into one. Now you may say, what's the big deal? I mean, what difference does it make whether I write name in one cell and address in another, or I write both name and address in one? What was happening was, many a times I had name but I did not have the address. Now if that address cell was blank, the return was not going forward. The return was not getting validated or being uploaded. So rightly or wrongly I had to enter something into that cell. Otherwise, the return did not get validated. They have probably realized this and they have clubbed name and address. Now, this would happen more in case of 80G cases where even PAN number is required. There also, I mean, we make a mention to that. For LLP and companies, the PIN number given, the LL PIN or the SIN given by the MCA is required to be mentioned. In respect of partners and directors, DPIN and PIN is also required to be mentioned in the return of income. Amounts claimed under 10A and 10AA earlier were in the return form under the head income from business. Now you will find they have been shifted from there, and this deduction is in the computation of total income after gross total income. Therefore, this is no more a deduction according to them from business income, but it is a deduction from gross total income. Refund will no more be available by way of a check, it will be only by way of a credit to your bank account. In case of companies which were banking, insurance or electricity companies preparing accounts not in accordance with Schedule 6, they have to tick mark and confirm that the accounts are prepared in accordance with the provisions of the respective law by which they are now governed and not by the Companies Act. Those of us who are required to furnish report under 92E, which is transfer pricing report, or 115JC, that is AMT, are required to mention the date of furnishing of return. In ITR 5, a new category has been added in status, which is private discretionary trust. In PNL, you have ITR 5 and 6 were identical. ITR 6 is for companies, ITR 5 is for others, firms, etc. Now, ITR 4, profit and loss account, has also been brought in line with ITR 5 and 6. So, in ITR 4, 5 and 6, you will have a profit and loss account format which is identical. Now, you may say it's good that it's identical. It's good, but those of us who are filing returns in ITR 4 did not have a lot of data which will now be required in ITR 4. We will have a look at it. For example, opening and closing stock earlier was one figure. Now it is RM, WIP, FG. This is simple. Commission, royalty, professional fee, consultancy fee, fee for technical service, interest paid to residents outside, paid to non-residents, or paid to non-resident in India or paid outside India needs to be separately stated. So this information will have to be compiled. Now, foreign travel expense was earlier part of traveling. Now it has to be stated separately. Other expenses you have to give nature and amount. This is important. Bad debts. Wherever you have claimed bad debts, and if the amount of each debt written off is more than 1 lakh, you have to give PAN number of the person whose debt you are writing it off. If you do not have PAN, there is an option. Aggregate all such cases where each amount is more than 1 lakh and you don't have a PAN. Give that as one figure. Then aggregate all cases where each amount is less than 1 lakh and give that as a separate figure. Mind you, the figures are separate. Then in other information, which was information which we would normally fill in from a tax audit report, the following are now required to be stated. Deduction under 80CCD, expenditure which is capital in nature and therefore not allowable under 36, but has been debited to PNL. You need to state that separately. Earlier you could merge everything not allowable irrespective of the reason, as like you would say expenditure not allowable without assigning reasons except for stating that it was personal expenditure was a separate cell. Others you could club it together. Now that's not allowed. STT is to be stated separately. Expenditure laid out or expended exclusively not for the purpose of business is to be stated separately. 48 to be state government undertaking, not of much importance, but there is a separate cell now. 48, 1, 1A and 3 were a consolidated amount. Now you have to state them separately, clause by clause. Now in case you have a recognized provident fund, you need to state number of employees which you have. So if an SSC has a provident fund which is a recognized provident fund, it has to state how many employees it has, and then he has to bifurcate how many were deployed in India and how many were deployed outside India. One would not know whether this is employees at any time during the year or employees as on 31st of March. Possibly you should take employees at any point of time during the year. Okay. Then under the head salaries, these allowances were earlier clubbed. We used to say allowances exempt under section 10. Now you have to give bifurcation into travel concession, tax paid by the employer on non-monetary perquisite, allowance to meet expenditure on house rent, and rest of them you can club as other allowances. For house property, what I did was I computed annual value of the property. But I computed only qua that portion which belonged to me. Now if you read the form, you get an impression that where there are more than one owners owning the property, he wants computation of annual value of the property as a whole. So to take an example, if me along with my wife own a property whose rent is 15,000 and we own it equally, say, I would earlier take 7,500 to be the annual value in my house property and finish off. Therefrom I would subtract municipal taxes, 30% and interest, and she would do same in her return. But now no, they say no, you compute 15,000 into 12, 1,80,000, subtract municipal taxes, come to the net annual value as we call it, according to law it's still annual value, then apply your percentage. That my SSC share is 50%, therefore 50% of that is mine, and then go over to 30% and interest. So please keep this in mind. I mean, one would normally, when one is doing the return, one would sit with the computation of the SSC, one may not have rent of the property, I mean, as a whole. So this is something one may have to keep in mind. In business income, earlier we used to say items of income considered under other heads. Now they are saying specify under which head? House property, other sources of capital gain. Expenses, we used to add back and say, okay, we are adding back here, but we will consider it under other heads. It was a combined figure. Now they want separate figures. Deemed income has to be stated. Now, short-term capital gain, long-term capital gain, major changes. The entire schedule has gone. For us, the entire thing has to be redone. Please have a look at every cell carefully. You need to compute short-term capital gain and 7 categories. Sale of land or building or both. Slum sale separately. Sale of equity shares or units of equity-oriented mutual fund on which STT is paid. For non-resident not being FII, from sale of shares or debentures of Indian company to be computed with foreign exchange adjustment in proviso. Again for non-residents, from sale of securities other than those stated above and sale of assets other than above. In these 5 categories you have to classify your STCG. LTCG, same way, sale of land and building, slum sale, bonds issue, bonds or debentures other than capital gain index bonds, sale of listed shares of securities or units of zero coupon bonds, NRS separately, and other assets. Again, for deductions claim, you have to specify under which section are you claiming a deduction, whether it's 54B, D, E, C, F, whatever it is. Then for each, you have to state the amount which you are claiming and the date of acquisition. See, for date of acquisition was a big controversy. When do you say that you have purchased a new house property? On day 1, when you get a letter of allotment that you have paid. See, I had an option to go and pay money to a builder and claim a deduction under 54 on the ground that I have appropriated the amount towards purchase of a house. I have appropriated the amount towards purchase of a house, not necessarily that I have purchased a house. The purchase would happen later on, as I explained earlier in the context of 56(2)(7)(b), etc., that when the building would come into existence, and that may happen in 2 years' time. The law gives me 2 years' time, but here now on day 1 itself is asking me what is the date of purchase. How am I to answer that question? What is the date of purchase on the date of allotment itself? I mean, that's the difficulty. Then again, intra-head set-off has to be stated. Now for intra-head set-off, you need to classify your STCG into 3 categories: 15%, 30%, and normal applicable rates. LTCG as 10% and 20%. So, and again, for the purpose of computing interest under 234C, you require to classify your capital gains up to 15 September, December, March, or in case of companies, June, September, December, March. Then under each subhead, and the subhead is rate-wise, so you have to calculate STCG 15% up to September, December, March, how much? STCG 30%, again in the 3 columns. STCG at normal rates, 15%, 30%, etc. So all this will require a lot of time. It is not going to come out so easily from your normal computation of income. So while preparing computation of income, please keep this change in mind so that filling up of forms becomes easier. Under other sources, no significant changes. Unabsorbed scientific research allowance, there is a separate schedule. Now here we have listed down information which you require and which is not necessarily available from your financial statements. We are dealing with filling of return form. Now when I fill the return form, the normal practice is I will sit with the computation of total income, I will sit with the balance sheet and profit and loss account and try to fill up the form. Now here we have listed down data which will normally not be available in your financial statements. Now the data is what? Date of birth of the assessee, date of formation, phone number of the assessee, email ID. Now this is important because now as per the press release given on Friday, I am dealing with the press release here itself, it says that when you log in for the first time into your account, you will be asked to give a phone number and an email ID. Earlier what used to happen is for a common phone number, on one phone number was given for 50 different assessees. Now they are saying no, we are going to accept one phone number only for maximum of 4 assessees. Same way for the email ID. They are saying one email ID will be valid for only 4 assessees. Now wherever I have already opened an account, I have already logged in, when I log in, it's again asking me to reconfirm the phone number and the email ID. On that very phone number and the email ID, I get separate pins. A pin number comes on the SMS and a pin number comes on email. I have to log in from the email itself and then enter those 2 pins and then I can proceed. In case of secondary phone number, you can have the common phone number for 100 people. So a chartered accountant's phone number can go as a secondary phone number. A chartered accountant's email ID can go as a secondary email ID. Right? Then you need PAN of the auditor, date of furnishing the tax audit report, DPIN, etc., name of employer. All this we did make a mention. Assessment year in which each of the units located in SEZ began to manufacture or produce. For 10A, 10AA, for each unit located in an SEZ, you have to specify the assessment year in which the manufacture or production commenced. For ATG deductions, you have to mention the PAN. You have to give information about the shareholders holding not less than 10% of the shares at any time during the year. Foreign assets information is the same information, nothing new. But please note that for foreign bank accounts, you are required to give the peak balance during the year. This is again something which will not be available in your financial statements. Then from balance sheet P&L, you will have to compile all this information mainly for Form 4. Now with this, maybe we can deal with the notification of wealth tax which has come yesterday. Now the notification says that who is required to file wealth tax return? Individual, HUF and company. They are saying that individuals and HUFs who are required to get their accounts audited under 44AB mandatorily have to file an e-wealth tax return. The physical filing will not be accepted. Nothing about affixing the digital signature, but I think digital signature will be required because anyway if you are getting your accounts audited, you have a digital signature, it's better to affix a digital signature and finish off the process there and then. So you have to definitely keep. Again, the form of return has undergone a change. It was earlier BA, now you have to file return for everybody in form BB. It's not form BA is no more valid, it's form BB effective AY 1415. Companies mandatory electronic return. Individuals and HUFs not covered by tax audit will be required to file the return, have an option if they are not covered by tax audit to file the return physically. Now, earlier Excel utility, when you fill the form without the software, by using the utility on the income tax website, you could open the form as an Excel file. Now it is Java based, therefore when you have to download the utility, you have to fill the form gets saved into your computer, but it will get opened only if you have a utility. So if you try to send the file of that form to your client for confirmation, confirm that the figures stated in the return are correct or not, the client will not be able to open the form unless he has also downloaded the utility. So when you are sending the return file to your client, also send him the utility so that he can first download or install the utility, then open the form, only then he will be able to check it. Of course, with the softwares available in the market, of course the Excel format is also available. I think with this we conclude. If there are any questions, we shall take. Thank you.
May I request you all to wait for a minute, just a minute please. J4 Jagdish has delivered a talk today and he's helped us learn so many things. But on 10th of July, J4 Jaitley is going to change all of this in all probability. I'll request Saroj to propose a vote of thanks and conclude the session. Thank you.
Friends, before I propose a very well-deserved vote of thanks, two small announcements. One is would be very relevant to you all because today's presentation would be available on the BCA website. So for reference, I'm sure you all will be happy to refer to it. And the second thing is we will be having the budget talk, the finance bill talk by Mr. Soli Dastur on 14th of July, which is Monday at Yogi Sabhagra. So we would request you all to attend there. And coming to the pleasant task, you would all agree, in fact the standing audience proves it, that this topic is of so much relevance, and Jagdish Bhai in the short span of 1.5 hours has taken us through so many things. In fact, for a lot of people who've been practicing for so many years, there are new things to hear and listen, and it's been a very well spent 1.5 hours. So I request all of you all to carry out a vote of thanks with a very loud applause.